What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are taking a look at a stock called Monday.com. In the last year, this stock is up 53%. If you don't know, this is a cloud-based software company that pretty much helps businesses with different types of software like marketing, like CRM, and like software building. So that's what this company does. I mean, 53% in a year is a great performance, even though they did suffer a bit of a drop recently. The stock was at 324. Now we're at 260. So we're going to do some analysis to see, is this a good stock to buy? And first thing we're looking at, well, first we got to know the market cap is $13 billion. Okay. But last year's revenue was 729 million. But in the last 12 months, we're actually at $900 million now. And it looks like for this year, we're expected to hit 965 in revenue. So nearly $1 billion in revenue. And profit margin is just above break even. We're at $21 million of profit. So not a lot, but we are expected to see EPS go up quite a bit to $3.21 this year, and then $3.70 next year. Now, from a PE basis, it is trading at quite a lot. If we divide 261 by 3.2, we're paying 81 times this year's earnings. And then 261 divided by next year's earnings, we're paying 70 times next year's earnings. Now, this is a very fast growing stock, so I don't want to say it's totally outrageous because when the stock is trading at 30% a year pretty much, sometimes it could be justified, right? There are certain stocks like Amazon that just trade at, 50, 60 times earnings, and you're lucky to get it cheaper than that. So that's just how some companies are. Maybe this is one of them. At the moment, they've been putting up really good numbers and they just got into profitability. And it looks like the next couple of years are going to be strong for them too. So I don't want to say it's totally outrageous to pay 70 times next year's earnings, even though really that's a lot. That's a lot. That's a big number. That's a lot of money to be paying. But if we look at their market cap compared to their sales in the last couple of years, we can see that in 2022, when things were really bad, that's when we had a crash, the stock traded down to 10 times sales. Okay. Well, right now, they're expected to do $1.2 billion of revenue for next year. Well, 10 times that is a little over 12 billion, right? And that's what the stock's at right now, a little over 12 billion. So, based off of next year's earnings, this very well could be pretty close to the bottom for the stock, right? Like maybe it goes to 240, 230, something like that. But I mean, as long as they put up good numbers and there's some good sentiment, we don't have a huge crash, this could be the bottom for the stock because they're a growing company. They put up good numbers. The stock deserves to trade at a premium, right? So take that into consideration. If we want to look at their balance sheet, we can see that they actually have a good ratio of cash to debt, 1.3 billion in cash versus only 65 million in debt. So balance sheet is solid, especially for a company that's hasn't been consistently profitable and is kind of starting off. That's really good that they're not in a bunch of debt. And it's very good that their shares outstanding is not accelerating like crazy either. So that's what I like to see. As far as in terms of investing in it right now, I mean, look at free cash flow too. Free cash flow has just been getting better and better. So that's another good thing. In terms of investing though, it is kind of risky, kind of scary because they just started getting profitable and we don't know what those numbers are going to look like. We also don't know what kind of premium this stock's going to demand. This stock could come down to 30 times earnings, right? If I would say worst case scenario with what they're doing right now, I would say for next year, $111 would be like worst case scenario. Not realistic though. Not realistic. I would say realistic is like 50 times, 50 to 60 times. So we'll say 55 times next year's earnings, the stock's $200. You see, and that's what makes me think it is realistic that the stock goes to 200 or 220, right? And that's why if it was at 200, maybe then I would consider buying. But at 260, this is maybe a fair value. I would say it's near a fair value. I would not say it's overvalued and I would not say it's undervalued. So it doesn't really make me want to invest. It makes me want to watch it though to see what it does, but I wouldn't really sell it. I wouldn't put a strong sell rating and I wouldn't put a strong buy rating. So that is my analysis for Monday.com. Let me know what you guys think down below.